Hi guys, I'm Phil Town from Rule 1 Investing, and today I want to talk to you about some of the, we should say, interesting viral investing advice on TikTok. Well, some of you may know there's a lot of investing and finance advice available at the click of a button. You have access to all kinds of educational resources online and qualities, but it can be really hard to tell which of these things are completely wrong, completely false, and which you can actually learn a lot from. Today, I'm going to talk specifically about investing advice from TikTok. So I've pulled a few clips I want to share with you guys, and these are going to kind of determine whether or not you should follow this advice as a Rule 1 investor, and I'll kind of give you my opinion. So let's dive in.
Long-term buying and holding. Basically, you buy a stock today and you hold it for years to come, 5, 10, 15 years. I always recommend for beginners to just go into consistent growth stocks. So for example, if you create a pie on M1, I would recommend just throwing in Apple, Amazon, Google, Microsoft, Tesla, etc. Just start with $1,000 emergency fund and then go and invest. You don't have to, but that's what I recommend.
Okay, well, you know what? That's not crazy. I'm starting off with really fairly decent set of advice, but the main thing is that these companies are really, really interesting potential investments. The problem is everybody knows it. And the trouble is when you buy companies that everybody already knows are good, chances are, particularly in the market right now, today at its historical highs, you're paying up a tremendous amount of money for companies that are probably going to grow slower in the future than they did in the past. And the only problem with that, it's great that she's telling you get in there and invest and throw the money in and forget about it for 15 years. But the only problem with it is chances are that you're going to get a reversion to the mean in terms of the growth rate. Other companies will be growing faster in the future. These companies will be growing slower because they're so huge already. There's a limit, right? The sky is not the limit. There's a limit to how much you can actually grow. And the result will be a relatively modest rate of return if you took that advice. And one of those companies, Tesla, man, who knows where that's going to be in 10 or 15 years when everybody in the world is making electric cars and they're up against Mercedes and Porsches and Teslas, every other kind of car company out there. So I really prefer that you guys think in terms of finding businesses that match your particular values. I'm not saying these companies don't. These are all very, very interesting companies. I like all of them actually, but I can't invest in them necessarily simply because they're hard to understand, some of them, very difficult to know enough about the company to know where it's going to be in 20 years, 15 years, 10 years, 5 years. But also because the price you're paying right now is just enormous for these things. But in general, as far as TikTok advice goes, this was not insanely horrible. I'll give her a C. All right, let's go on to the next one.
Apple, Facebook, Visa, Nikola, Amazon, Coca-Cola, ETFs. These are not the type of stocks you buy to make a lot of money. That's not where big money is made. What about value investing and holding stocks for 7, 8, 10 years? No, that's also not how you make big money. In fact, that takes a long time. What you need to do is become a contrarian. Make money in stocks that nobody's paying attention to when nobody wants them when they're at a huge discount. You buy $1 for 50 cents, then rinse and repeat over and over. In fact, the less money you have, the bigger advantage you have. And the more money you have, the harder it is.
Well, that was kind of fun actually, because he's a little bit contradicting himself. If he doesn't mind if I say it, I think he could probably define his way out of this, but essentially he's telling you, don't go out there and buy the way Warren Buffett does. You see him cross out Warren Buffett, right? Perhaps he didn't realize that Warren Buffett's rate of return would make anybody a multi-millionaire over a period of time. Now, what he's suggesting is you basically do what Warren Buffett does, buy dollar bills for 50 cents and then rinse and repeat. That is just Warren Buffett Investing 101. And you've seen that Warren Buffett has made 50% a year after year, when he was just getting started with small amounts of capital. So I also agree with him that small amounts of capital do give you an advantage, because you're going to be able to find more businesses that are on sale when you're starting with a small amount of money than if you start with billions of dollars. There's a huge disadvantage in having a lot of money to invest. So small investors really do have an advantage when they're looking for bargains, when they're looking to buy a dollar bill for 50 cents. That's what you want to be. You want to be small. You'll have more advantages that way. But to think that you could do it better or faster than Buffett could do it, Warren said that if he only had $1 million to work with right now, he could make 50% a year guaranteed. If you're making 50% a year guaranteed, sports fans, you are going to be doing super, super good out there. I wouldn't worry too much about it. So it cracked me up a little bit. The guy's basically talking about the kind of investing we do, and we teach at Rule 1 Investing, but acting as if it isn't that way. And it is. It absolutely, what we do is go out there and find dollar bills available for 50 cents. Now, the only real problem that he's got is being able to find them. Going out and finding those things that are on sale for real, that you understand, because of course you can't buy them on sale if you don't understand what they're worth, right? Then, you're not going to be able to find those all day long. And particularly in this market, extremely hard to find them at all. So get rich quick? I doubt it. Get rich? Yeah, great. 50 cents on the dollar, you're going to get rich, but it's going to take some time. All right, third video.
Did you hear the stock market's about to hit a record high? Well, it's time to go all in. Well, wait a second. You should never go all in on one investment. What do you mean? You just said it's about to hit a record high. Think about if you went all in on airline stocks. You would have lost 60% when they crashed in 2020. But isn't that a risk with any investment? Not with a properly diversified portfolio. If you invest in ETFs that give you a diverse mix of tech stocks, real estate, and commodities, you're much better protected against volatility.
This is a young guy spitting out a theory of investing that got started back in the 50s. It became mainstream in the 1960s after a paper written by Richard Fama from the University of Chicago, and is the mainstream investing advice for virtually all the Ivy Leagues out there, and completely what Warren Buffett would recommend for you if you're not going to learn how to invest. Then you should diversify. You should buy ETFs. You should just stay in the market. Not that it's going to protect you from serious market volatility, but that in the long run, it's going to be a winner. I think I've said before that over a 200-year period of time, the stock market has produced 1,000,000 to 1 rate of return post-inflation. Oh, 1,000 times better than any other investment you could have. So absolutely, if you're not going to learn to invest, do what this guy says. It's not that far off. But unfortunately, the stock market is also fully capable of being extremely volatile, dropping 50%, rising up 100% back to where it was, dropping another 50%. From 1966, when I kind of was just coming out of school, 1966 to 1983, the stock market moved up and down 40 to 50%, I think 20 times. It's just some enormous amount of times without ever going above the stock market price it had in 1965. So this is the big fallacy that he's talking about. The big fallacy that he's proposing is to get away from volatility. Man, I got some news for you. The stock market can go down 50% and never go up for 25 years. And leave you with a zero rate of return. That has happened multiple times, and we don't want it to happen to us. So the main thing you should do is avoid massive diversification by learning how to pick a few wonderful businesses. Now, we're not going to get one and go all in, right? We don't need to be extreme about it. But if you find 10 companies, actually Warren Buffett says, if you find 20 in your lifetime, you will get rich. So 20 companies, it's not crazy. Right? You don't have to diversify all over the market. And by diversifying, you're guaranteeing yourself a miserable time over some long period. And my guess is that long period's coming up pretty soon. Now, I'd love to hear from you guys. What do you think of this investment advice on TikTok? Anything you agree or disagree with? Leave a comment below with your answer. I'll be sure and follow up with you. Now, thanks for watching, you guys. Now go play. Hey, if you enjoyed this video and you feel it was valuable for teaching you more about the worst investing advice on TikTok, hit the like button and please share the video with your friends. And if you want more investing content, subscribe to my channel. And don't forget to click the button on the screen for a free gift. And thanks for watching. See ya.